The International Monetary Fund recently issued a stark assessment that reveals something profound about the changing architecture of global finance. What they've documented isn't just an economic trend, it's a fundamental realignment of power that threatens to reshape how the world conducts business. At the heart of this transformation lies a simple but seismic reality. Nations across the developing world are systematically reducing their dependence on the US dollar and embracing China's yuan as a viable alternative. This isn't happening quietly in the background anymore. The scale of this shift has grown so significant that even the IMF, an institution historically aligned with Western financial interests, can no longer ignore it. Consider the numbers from just this year. Between January and September alone, China deployed lending mechanisms that expanded its financial reach by more than $2 trillion. That's not a typo. We're talking about a sum equivalent to the entire GDP of countries like Italy or Brazil being channeled into global credit markets in less than a year. This kind of financial muscle gives Beijing unprecedented influence over emerging economies, and it's pulling these nations decisively into China's economic sphere. For decades, the United States enjoyed what economists call exorbitant privilege, the ability to borrow cheaply, impose sanctions effectively, and shape global economic policy simply because the dollar was the world's undisputed reserve currency. But that privilege is eroding, and the erosion is accelerating. What's driving this change? The answer involves more than just China's ambitions. It also involves America's own actions. Years of unpredictable trade policies, escalating tariff wars, and political volatility have created an environment where the dollar no longer represents the stability it once did. Countries that depend on international trade and investment are looking for alternatives that don't leave them vulnerable to sudden shifts in Washington's political mood. China recognized this opening and moved decisively to fill it. Through a combination of lower-cost loans, more flexible lending terms, and a rapidly expanding financial infrastructure that operates independently of U.S. oversight, Beijing is offering nations something they desperately want: predictability and options. This is why the IMF's warning matters. When the institution responsible for maintaining global financial stability starts publicly acknowledging that the dollar's dominance is under threat, you know the transformation is already well underway. So how did we reach this critical moment? How far can this shift actually go? And what does it mean for the future of American economic power? To understand where we're headed, we need to examine the concrete mechanisms driving this change, starting with the staggering expansion of yuan-denominated credit. Part 1. The numbers that reveal everything. When you look at the lending figures coming out of China, what emerges is a picture of strategic ambition operating at a scale most observers didn't think possible. According to data released by the People's Bank of China, new yuan-denominated loans reached nearly 15 trillion yuan during the first 10 months of 2025. Convert that figure into dollars, and you're looking at approximately $2.1 trillion in fresh credit flooding into the system. To put that in perspective, that's more than the annual economic output of Canada or South Korea being created through loans in less than a year. This isn't routine economic activity. This represents a deliberate strategy by Beijing to extend its financial reach across the globe while simultaneously addressing domestic economic challenges. China's economy has been facing significant headwinds. The property sector, which represents a massive portion of domestic wealth, has been contracting. Export growth has slowed amid weak global demand and ongoing trade tensions. Consumer confidence at home has softened. Under normal circumstances, this might force a government to pull back on international ambitions and focus inward. Instead, Beijing made a calculated decision to do both at once. By expanding credit aggressively, China stimulates its domestic economy while simultaneously using that same lending power to extend yuan influence abroad. Every credit facility extended to a foreign government or business, every currency swap agreement signed, every offshore loan issued serves a dual purpose. It supports economic growth at home while building dependencies abroad. This approach kills two birds with one stone, and it directly challenges the dollar's role as the default currency for international commerce. A critical component of this expansion involves something called bilateral currency swap agreements. These arrangements allow foreign central banks to access yuan liquidity directly from the People's Bank of China without needing to first convert their reserves into dollars. What might sound like a technical banking procedure is actually a form of geopolitical positioning. When a country enters into a yuan swap line with China, it gains the ability to stabilize its currency and manage financial crises without relying on dollar reserves or approval from Western institutions like the IMF or Federal Reserve. This creates a relationship of dependency, but the dependency runs toward Beijing, not Washington. We can already observe how this dynamic plays out in real-world terms across Latin America. At the CELAC China Forum held in May 2025, President Xi Jinping announced a massive new credit facility for the region, 66 billion yuan specifically earmarked for development projects. Critically, every yuan of this facility is denominated in China's own currency, not dollars. But China didn't stop with just credit. Beijing also committed to more than 100 collaborative infrastructure projects spanning energy development, transportation networks, and digital technology systems. These aren't small ventures. They represent the foundational architecture of modern economies: ports, power grids, telecommunications networks, highways. When a country builds its critical infrastructure using Chinese financing, Chinese contractors, and Chinese technology, the relationship extends far beyond a simple loan. That nation becomes integrated into China's economic ecosystem, and that integration makes it progressively harder to pivot back toward Western financial systems. Consider the maritime dimension of this strategy. According to research from the Center for Strategic Studies, Chinese companies now own stakes in or operate 31 different port facilities across Latin America and the Caribbean. Many of these ports occupy strategically vital positions along major shipping routes that connect the Pacific and Atlantic Oceans. Control over port infrastructure translates directly into leverage over supply chains, and leverage over supply chains provides political influence that extends far beyond economics. When a country depends on Chinese-operated ports to export its commodities or import its consumer goods, Beijing gains meaningful leverage over that nation's policy decisions. The offshore yuan market, sometimes called the dim sum bond market, has also experienced explosive growth. These are bonds denominated in yuan but issued outside mainland China, allowing foreign governments and corporations to raise capital directly in Chinese currency. 20 years ago, this market barely existed. Today, it represents a sophisticated financial ecosystem that provides alternatives to dollar-based funding. Meanwhile, borrowing costs in the United States have been climbing. The Federal Reserve's aggressive interest rate increases to combat inflation have made dollar-denominated debt significantly more expensive for developing nations. When you're a finance minister in a country struggling with debt payments and you're offered a choice between expensive dollar loans with strict conditions or more affordable yuan financing with fewer strings attached, the decision becomes straightforward. Argentina provides a particularly revealing case study of how these dynamics work in practice. The country recently expanded its bilateral currency swap agreement with China to 5 billion yuan, effectively giving Buenos Aires the ability to conduct trade and settle debts directly in Chinese currency without touching dollars. These kinds of bilateral arrangements fundamentally alter the economic relationships between countries. Nations that once had no choice but to participate in dollar-centric financial systems now have options. And when countries have options, America's ability to influence their decisions diminishes. For the United States, watching this transformation unfold across Latin America represents something more than just lost business. Latin America has been within Washington's sphere of influence for more than a century. The Monroe Doctrine, American military interventions, economic aid packages, trade agreements, All of these were designed to keep the region aligned with U.S. interests. But as more governments in the region borrow in Yuan, build infrastructure with Chinese funding, and integrate Chinese technology into their economies, they naturally drift away from dollar-based systems and toward Beijing's orbit. This shift in economic gravity carries profound geopolitical implications. And that brings us to how Washington is attempting to respond, specifically through the Trump administration's approach to Argentina. Part 2. When billions can't buy influence. The United States recently announced a significant financial arrangement with Argentina that appeared designed to counter Chinese influence. On the surface, it looked like a reassertion of American economic power in a region where China has been steadily gaining ground. But when you examine the details, a very different picture emerges. The U.S. Treasury, led by Scott Bessent under President Trump, agreed to establish a $20 billion currency swap facility with Argentina. President Javier Milei, who has cultivated close ties with Trump and positioned himself as a pro-market reformer, welcomed the arrangement as a partnership between like-minded governments. The optics suggested Washington was stepping up to support a strategic ally and demonstrate that it remains the dominant economic force in the Western Hemisphere. But the underlying reality tells a more complicated and, frankly, contradictory story. Despite receiving this massive financial support from the United States, Argentina continues to deepen its economic relationship with China at an accelerating pace. Trade between the two nations isn't contracting, it's expanding rapidly. Take agricultural trade as one clear example. After Argentina reduced export tariffs on soybeans, China moved quickly to purchase approximately 7 million tons of Argentine soybeans. For Argentina's struggling economy, this represented desperately needed foreign currency and, a critical boost to its agricultural sector. But for American farmers, who have been effectively shut out of China's massive agricultural market due to ongoing trade tensions, this development stings. They're watching their own government provide billions in financial support to a country that's simultaneously capturing market share that U.S. producers used to hold. The irony becomes even sharper when you consider the financial structure. While U.S. officials insist that the swap line is not a bailout, the practical effect is nearly indistinguishable from one. American banks are simultaneously discussing an additional $20 billion in potential loans to Argentina, which would push total U.S. financial support close to $40 billion. And yet throughout all of this, Argentina has continued expanding its yuan-denominated swap agreements with China, signing new deals structured in Chinese currency, and deepening its integration into Beijing's financial architecture. This creates a situation where Washington is spending enormous sums to keep Argentina within its sphere of influence, while Argentina uses that financial breathing room to move closer to China's economic orbit. American taxpayers are essentially subsidizing Argentina's pivot toward Beijing. The agricultural dimension makes the contradiction impossible to ignore. U.S. farmers lose access to one of the world's largest agricultural markets because of tensions between Washington and Beijing. Meanwhile, the U.S. government pours billions into supporting a country that's actively expanding its sales into that same Chinese market. From Buenos Aires' perspective, the logic is straightforward. Why choose between Washington and Beijing when you can take financial support from both? But from Washington's standpoint, this represents a fundamental failure of economic statecraft. The United States is discovering that money alone cannot buy alignment when structural economic incentives point in a different direction. This dynamic isn't unique to Argentina. It's becoming a pattern across the developing world. Countries are learning that they can maintain relationships with Washington for security and diplomatic purposes, while increasingly conducting their economic affairs through Chinese financial channels. The result is that America's traditional tools of influence, financial aid, trade agreements, access to dollar liquidity, are becoming less effective precisely when they're needed most. And this brings us to the broader infrastructure that China is building to make these shifts permanent. Part 3. Building a Parallel Financial Universe. What China is constructing goes far beyond individual loans or bilateral trade agreements. Beijing is systematically building alternative financial infrastructure that allows countries to operate outside the dollar system entirely. And the scale of this construction has accelerated dramatically. Over the past 5 years, external renminbi lending, deposits, and bond issuance by Chinese financial institutions have quadrupled, reaching more than 3.4 trillion renminbi, so that's approximately $480 billion. This isn't normal credit expansion driven by market demand. Instead, this represents deliberate construction of financial plumbing that bypasses the dollar-based architecture that's really dominated global commerce since World War II. Central to this new infrastructure is CIPS, the cross-border interbank payment system. While it doesn't yet rival SWIFT in total transaction volume, CIPS has been growing at an impressive rate, now processing trillions in annual settlements and providing countries with a mechanism to conduct international transactions directly in Yuan. For nations facing US sanctions, struggling with dollar shortages, or simply trying to reduce borrowing costs, having access to an alternative payment system provides meaningful strategic value. It creates optionality that, honestly, just didn't exist a decade ago. This infrastructure is already reshaping global commodity markets. Increasingly, transactions involving oil, natural gas, metals, and agricultural products are being settled in yuan rather than dollars. The shift became particularly pronounced after China and Russia expanded yuan-based trade and energy following Western sanctions on Moscow. Brazil has also formalized yuan settlement arrangements with China for major commodity exports, including soybeans and iron ore. This allows billions of dollars worth of trade that, historically, would have been conducted entirely in US currency, to bypass the dollar completely. The statistical evidence of this transformation is becoming, well, undeniable. The yuan's share of global trade finance has surged, recently overtaking the euro to become the world's second most utilized currency for trade settlement after the dollar. Within the International Monetary Fund's special drawing rights basket, a reserve asset composed of major currencies, the yuan's weight has gradually increased, reflecting growing international acceptance of Chinese currency as a legitimate reserve asset. Meanwhile, China is actively promoting its digital yuan across international borders. Multiple countries in Southeast Asia and the Middle East have participated in pilot programs testing cross-border payments using digital yuan infrastructure. These systems offer lower transaction fees and faster settlement times compared to traditional correspondent banking networks. For developing economies constantly struggling with the costs and delays of international payments, these practical advantages make digital yuan infrastructure genuinely attractive. It's not just about geopolitics, it's about efficiency and cost savings. The downstream effects of this expanding ecosystem spread rapidly. Countries that, historically defaulted to dollar-denominated borrowing are now structuring portions of their debt in yuan because, well, it's become cheaper and easier to service. Kenya has explored yuan-denominated debt options. Sri Lanka has discussed converting portions of existing obligations into Chinese currency. Even nations traditionally aligned with the United States and Latin America are, investigating financing through BRICS institutions and Chinese policy banks instead of Western lenders. This really represents the real transformation. Each new yuan-denominated loan issued, each currency swap agreement signed, each commodity transaction settled in renminbi makes the dollar just a bit less essential to global commerce. China isn't just promoting its currency. It's methodically replacing the foundations of the dollar-led system with an alternative architecture. And this systematic challenge to dollar dominance has, finally triggered panic in Washington. Part 4. When the foundation cracks. President Trump recently issued a stark warning that revealed just how seriously the administration views this threat. He stated that the United States could face both an economic and national security catastrophe if the Supreme Court were to rule against his tariff policies. What he was really acknowledging, though perhaps not explicitly, is that America's financial leverage is eroding, and the system that maintained dollar dominance for generations is honestly becoming unstable. To understand how we reached this point requires examining the policies that created the instability in the first place. President Trump invoked emergency powers under the International Emergency Economic Powers Act to impose sweeping tariffs on nearly every major U.S. trading partner. The scale and unpredictability of these actions, sent shockwaves through global markets. Countries that had built their economic planning around predictable trade relationships with the United States suddenly faced massive uncertainty. This uncertainty forced governments worldwide to ask a fundamental question. If U.S. trade policy can shift dramatically based on political calculations rather than economic logic, can we really afford to remain completely dependent on dollar-based trade and finance? Even within the United States, legal challenges emerged. The Supreme Court signaled skepticism about whether the emergency powers being invoked actually provided legal authority for such broad tariff implementation. This internal legal uncertainty just compounded the international confusion. For global investors who had treated U.S. Treasury bonds as the ultimate safe haven, the foundation of any diversified portfolio, this created genuine concern. When the world's most stable economy begins behaving unpredictably in trade policy, when its domestic institutions question the legal basis for major economic decisions, the assumption of absolute safety starts to crack. When confidence weakens, the dollar's structural advantages weaken with it. Demand for Treasury securities can decline. Borrowing costs can rise. The automatic power that comes from issuing the global reserve currency, it diminishes. While the United States stumbled through this self-created instability, China pursued the exact opposite strategy. Beijing expanded currency swap networks, increased Yuan financing options, and deepened partnerships with countries actively seeking alternatives to dollar dependence. China didn't need dramatic announcements or aggressive marketing. It simply built viable alternatives and allowed frustrated nations to discover them. The result has become increasingly clear. More countries are conducting transactions in yuan. Fewer are assuming that dollars represent the only option for reserves or trade settlement. And this shift is precisely what triggered the International Monetary Fund's warning about the changing monetary order. Part 5. The IMF's desperate defense. The IMF's latest assessment sounds measured and technical, as these institutional statements always do. But underneath the diplomatic language lies something that looks very much like desperation. Publicly, the fund is urging countries to proceed cautiously before shifting away from dollar reserves, insisting that any moves toward yuan holdings must align with long-term debt management and reserve diversification strategies. It's a clear attempt to slow the momentum away from the dollar and preserve the existing monetary hierarchy. But behind this public messaging, the transformation is already well underway. And the IMF knows it. Data from central banks worldwide reveals a decisive pattern emerging throughout 2025. Monetary authorities are systematically reshaping their reserve compositions, and the direction of change points unmistakably away from dollar concentration. According to surveys conducted by the World Gold Council, 76% of central banks indicated plans to increase their gold holdings over the next 5 years. Even more tellingly, 73% expect their allocation to dollar-denominated assets to decline during the same period. These aren't minor portfolio adjustments. These are signals that global monetary authorities are reassessing fundamental assumptions about dollar stability and making long-term strategic decisions accordingly. And then comes perhaps the most symbolically significant shift. For the first time in multiple decades, central banks worldwide now collectively hold more gold in their reserves than U.S. Treasury securities. That single milestone captures how dramatically global confidence has evolved and explains why the IMF has become so vocal about defending the dollar system. Countries aren't simply weighing whether to hold yuan versus dollars. They're moving into assets that provide independence from any single major currency altogether. Gold doesn't carry counterparty risk. It can't be frozen by sanctions. It doesn't depend on any government's fiscal discipline or political stability. From Washington's perspective, this dual trend represents a severe strategic threat. While the IMF publicly discourages rapid pivots toward yuan reserves to protect dollar dominance, central banks are quietly acting on a fundamentally different assessment of future risks. They're broadening diversification, accumulating gold, and exploring new financial frameworks that reduce dependence on the United States. The system the IMF is attempting to defend is slipping away even as the institution warns the world not to let go. The foundation is cracking, and everyone can feel it shifting underfoot.